Hey there, Stock Market Insights viewers. We all love it when stocks go up, right? But did you know you can make money even when they go down? That's the power of short selling. It might sound counterintuitive, but trust me, it's a strategy used by Wall Street pros every single day. In the next few minutes, I'm going to break down this powerful tool so you can understand how it works and see if it's right for you. Remember, knowledge is power, and in the world of investing, that power can translate into profits. So buckle up and let's dive into the exciting world of short selling. Short selling is essentially the reverse of traditional buying and selling. Instead of buy low, sell high, you're doing the opposite, sell high, buy low. I know, it sounds strange. How can you sell something you don't own? Well, when you short sell, you're essentially borrowing shares of a stock from your broker and selling them in the market. The hope is that the stock price will go down. If it does, you can buy back the shares at a lower price to replace the borrowed ones, pocketing the difference as profit. Let's say you believe company XYZ's stock, currently trading at $50 per share, is overvalued and due for a drop. This belief might be based on various factors such as recent financial reports, market sentiment, or even broader economic indicators. You might have noticed that the company's earnings have been declining, or perhaps there are rumors of management issues. Whatever the reason, you are convinced that the stock price is going to fall. You decide to short sell 100 shares. Short selling is a strategy used by traders who anticipate a decline in a stock's price. Essentially, you are betting against the stock. To do this, you need to borrow shares from your broker, which you will then sell at the current market price. The goal is to buy them back later at a lower price, return them to the broker, and pocket the difference. You borrow 100 shares from your broker and immediately sell them in the market for $5,000, 100 shares times $50 per share. This transaction is straightforward. You now have $5,000 in your account, but you also owe your broker 100 shares. The risk here is that if the stock price goes up instead of down, you will have to buy back the shares at a higher price, resulting in a loss. A week later, your prediction comes true, and company XYZ's stock plummets to $25 per share. This decline could be due to a variety of reasons. Perhaps the company released a poor earnings report, or maybe there was negative news affecting the entire industry. Regardless of the cause, the stock price has dropped significantly, just as you anticipated. You buy back 100 shares for $2,500, 100 shares times $25 per share, to return to your broker. This process is known as covering your short position. By buying back the shares at a lower price, you are able to return them to your broker and keep the difference as profit. Your profit is $2,500, $5,000 minus $2,500. This profit calculation is simple. You initially sold the shares for $5,000 and then bought them back for $2,500. The difference between these two amounts is your profit. You made money when the stock price went down. This is the essence of short selling, profiting from a decline in a stock's price. It's a strategy that requires careful analysis and timing, but when executed correctly, it can be highly profitable. However, it's also important to remember that short selling carries significant risks, as the potential for loss is theoretically unlimited if the stock price rises instead of falls. Short selling can be very profitable, but it's not without risks. The biggest risk? Unlimited potential losses. Remember, when you buy a stock, the most you can lose is your initial investment. But when you short sell, your potential losses are theoretically unlimited because the stock price can rise indefinitely. If company XYZ stock had surged to $100 per share instead of dropping, you'd have to buy back those shares at a much higher price, resulting in a significant loss. That's why short selling is best suited for experienced traders who understand the risks involved. Section 5. Market orders, instant execution, price uncertainty. Now let's talk about how you actually buy and sell stocks, both for regular trades and short selling. Understanding the mechanics of placing orders is crucial for any trader, whether you're a seasoned professional or just starting out. The type of order you choose can significantly impact your trading strategy and outcomes. There are two main types of orders: market orders and limit orders. Each serves a different purpose and comes with its own set of advantages and disadvantages. Knowing when and how to use each type can make a big difference in your trading success. A market order is an order to buy or sell a stock at the best available price in the market at that moment. This type of order guarantees execution but does not guarantee the price. It's the most straightforward type of order and is often used when you need to enter or exit a position quickly. It's like walking into a store and paying whatever price tag is on the item you want. You get what you need immediately, but you might end up paying more than you expected if prices have changed. Market orders are executed quickly, which is great if you need to get in or out of a trade fast. Speed is often crucial in trading, especially in volatile markets where prices can change in the blink of an eye. This immediacy can be a lifesaver in fast-moving markets. However, you don't have control over the exact price you'll get. This lack of control can be a significant drawback, especially in highly volatile markets where prices can swing dramatically in a short period. You might end up buying at a higher price or selling at a lower price than you anticipated. This uncertainty can be stressful, particularly for new traders who are not yet accustomed to the rapid pace of the market. It's essential to weigh the pros and cons of using market orders and to consider your own risk tolerance and trading goals. In the next section, we'll delve into limit orders, which offer more control over the price, but come with their own set of challenges. Stay tuned to learn how to use these tools effectively to enhance your trading strategy. Section 6. Limit orders. Price control, execution uncertainty. A limit order, on the other hand, allows you to set a specific price at which you're willing to buy or sell. This means you have the power to dictate the terms of your trade, rather than accepting the current market price. For example, if you want to buy a stock but only if it drops to a certain price, you can set a limit order to automatically execute the trade when that price is reached. It's like telling the store, "I'll only buy this if it's $50 or less." This approach can be particularly useful in volatile markets where prices can swing dramatically within a short period. By setting a limit order, you can avoid overpaying for a stock or selling it for less than it's worth. The advantage is that you have more control over your entry and exit points. This control can be crucial for traders who have a specific strategy in mind and want to stick to their plan without being swayed by market fluctuations. It allows for a more disciplined approach to trading, which can be beneficial in the long run. However, there's no guarantee your order will be filled. This is the trade-off you make for having more control over the price. If the stock never reaches your limit price, your order will remain unexecuted, and you might miss out on potential trading opportunities. If the stock price doesn't reach your limit price, your order won't be executed. This can be frustrating, especially if the stock price comes close but doesn't quite hit your target. It's a risk you have to be willing to take if you want to use limit orders. So, which type of order is better? The answer isn't straightforward. It largely depends on your trading style and risk tolerance. If you prefer to have more control over the price at which you buy or sell, and you're willing to accept the risk that your order might not be executed, then limit orders might be the better choice for you. It depends on your trading style and risk tolerance. Some traders are more comfortable with the certainty of market orders, even if it means they might not get the best possible price. Others prefer the precision of limit orders, even if it means they might miss out on some trades. Market orders are good for speed but offer less price control. They are executed almost immediately at the current market price, which can be advantageous in fast-moving markets where every second counts. However, this speed comes at the cost of potentially paying more or selling for less than you intended. While limit orders give you more price control but might not be filled, this makes them a better option for traders who are patient and have a specific price in mind. Ultimately, the choice between market and limit orders comes down to your individual trading goals and how much risk you're willing to take on. Section 7, Spreadsheets, your trading command center. Now let's talk about a crucial tool for any serious trader: spreadsheets. No, they're not as glamorous as flashing stock tickers, but trust me, they're essential for tracking your trades, managing your risk, and making informed decisions. Think of a spreadsheet as your trading command center. It's where you record all your trading activity, analyze your performance, and plan your next moves. A well-organized spreadsheet will help you stay organized, identify your strengths and weaknesses, and ultimately make more profitable trades. Section 8, Essential Spreadsheet Elements. Tracking your trades. What should you include in your trading spreadsheet? Here are some key elements: date, stock symbol, trade type, buy/sell/short sell cover, number of shares, entry price, exit price, profit, loss, and notes. The notes section is where you can jot down your rationale for each trade, any news or events that might have influenced your decision, and lessons learned. By diligently recording and reviewing your trades, you'll start to see patterns emerge. You'll learn what works for you, what doesn't, and how you can improve your trading strategy over time. Section 9. Disclaimer. Proceed with caution. Short selling can be a powerful tool for experienced traders, but it's crucial to remember that it carries significant risks. Before even thinking about short selling, make sure you have a solid understanding of the stock market, risk management techniques, and your own risk tolerance. This information is for educational purposes only, and is not financial advice. And hey, if you found this video helpful, don't forget to like, subscribe, and ring that notification bell for more trading tips and insights.